Welcome back to Put Paradise. We're going over the Put Path 101 course, lesson number 4, Introduction to Put Credit Spreads. So let's go over the basics of how these set up. What are put credit spreads and what are the benefits of put credit spreads? Put credit spread basically is selling a higher priced put and then buying a lower priced put in the same expiration, days to expiration calendar time frame. You do that buying and selling simultaneously. The goal is to profit from the credit that you collect, making sure, striving for the underlying not breaching the price of the put that you sold. So you're going to have defined limited risk. You're going to collect that income upfront. You're going to have limited downside risk because you have bought that put as protection. So this is suitable for bullish market, neutral market, and a bearish market for that underlying. And you have better risk management compared to naked puts. So let's get into some of the details on exactly how these put credit spreads work. So you've got, again, two legs simultaneously entered. You sell the higher strike put and you buy the lower strike put in a single transaction. That's important. You don't want to leg in or out of these. That lets you create your net credit and defines your trade from the start. So what's the net credit from? The net credit is because you're selling the higher strike put, and that brings in more premium to you than you pay for the lower strike put when you buy that one. The difference is your net credit, and that's deposited into your account immediately. And again, we're trying to make sure that these stay out of the money and they both expire worthless. So this is a defined risk trade, meaning it's defined by the width between the two puts. And unlike a naked put, your maximum loss is capped at the difference between the two strike prices. So again, the long put acts as your safety net. That's your downside risk protection. So if you have a $5 wide spread, you're going to have $500 worth of total risk. And that's how you're going to define that position. Also, we use weekly expirations. So you can do calendar spreads, you can do diagonal spreads, do some different things. But for all of our spreads, we're going to be sharing the same calendar week, making sure that we have the same expiration for both. Okay, I like examples, and we're going to go through an example that'll hopefully help you out. So this is an example from the real world. We got a trade here in QQQ. This was in November of last year. The stock was around 608. We went out 28 days to expiration. So what we would do here is you sell the QQQ at 560. And this is, again, at the 15 delta. And that would bring in $3.83. And then simultaneously, we bought the QQQ at the 555, and that was for 333. So that gives us a net credit of 50, which is our target on QQQ. So that's right in line with what we want. So the inverse of that is what happens if you lose. The max risk would be $500 minus the 50 cents to give you $450 as your max loss. You may be asking yourself, why would I ever want to do that? You're telling me that I can gain $50 or I could lose $450 as a max loss. Well, the reason we do it is because the odds are in your favor. 70% of options that are bought expire worthless. So options trading is really a trade-off between risk and reward. What we're doing is collecting the premium upfront and letting the probabilities work in our favor. Let's do another example. This time it's theoretical. So if we were looking at the call side, sometimes it's easier for people to conceptualize the call side. So we have a underlying XYZ at $100. So let's say you were going to buy the 105 call 30 days out. It might cost you $1, which in 100 shares means $100. So you pay $100 up front. You have a call that's in your account. Now, As that goes towards expiration, there's three different things that can happen. You could stay below 105 at expiration. In that scenario, the option expires worthless and you lose all of that money. So that's max loss, $100. Or it could go between 105.01 and 105.99. So if it's 1 cent up to 99 cents in the money, you're going to have a partial recoupment of your money. You're still going to lose, but you're going to get some money back. So if it's at 105 and 0.01, you're going to get 0.01 back. So you'd receive $1 back. And that's all the way up to 99.99, you would get $99 back. Still lose money, but it's a partial premium recoupment. Above 106, now you're getting into the profit zone. Anything above 106 at expiration means that you made money. So let's say the stock was at 109 at expiration. You would have $400 coming to you. You spent $100 upfront, so you would have $300 net profit. Buying calls does work, and people love to buy calls. The odds favor the sellers, though. So we're going to learn about selling options. We're going to learn about selling puts specifically. Let's take a look at what it would be like to sell a call credit spread. So this would be a bearish position. In this example, we've got XYZ stock at 100 again. We're going to sell the 105 call. We're going to buy the 106 call for protection. Let's say for 65 cents. The net credit we receive is 35 cents. We do this simultaneously, execution, and this would be a vertical spread. In our case, a credit spread. What's that look like for the counterparty buyer? So the buyer is going to pay you $1 in premium upfront. And if the stock stays below 105 at expiration, then you're going to receive that full $100. So the buyer needs a significant move just to break even. It's a low probability outcome. The counterparty on the sold call is going to collect 65 cents credit. They have sold us the 106 position. So that seller is going to win in three different scenarios. If the stock falls, if it stays flat, or even if it goes up right below 106. So they have the best position. So why do I say that? Why do we sell? Because selling credit spreads, selling options offers a statistical advantage. Approximately 70% of options expire worthless, meaning the sellers are going to win more often. Also, historical volatility is less than the implied volatility, so you have an edge there. Also, when you buy an option, you have to be right on direction, magnitude, and timing, and that is hard to do. That is why we focus on put credit spreads. Put skew gives the sellers a built-in edge with higher premiums on the put side. Don't fight the market. We're in a perpetual bull market and we have been for decades. With put credit spreads, you have a higher probability of profit thanks to a favorable risk-reward balance. You've got historical volatility less than the implied volatility, which gives you your edge, and then you have better long-term consistency compared to directional trading strategies where you're trying to figure out if it's going to go up or if it's going to go down and buy how much and within what time period. Play the percentages and sell the put credit spreads. Let's go through another example and I can show you how one of these guys sets up. So look at DIA, which is your Dow Jones Industrial Average. This is one of the indexes that we trade. Let's take an example where DIA is at 465.35, 28 days to expiration. A typical trade would be selling the 445 put, which is about 5% spread between the current price and the strike price. So this would be equivalent to the 15 delta that we're looking for. You sell that for $4.70, and then you buy the 440 put for $4.30. So that's a $5 wide spread that gives you a net credit of 40 cents, which is $40 profit if DIA stays above 445 with a max risk of $460. You compute that because you have a $500 max risk minus the credit that you're getting back. So 500 minus 40 is $460. Our mission is to transform your life by simplifying the way you trade. So simplicity is built into the PutPath options trading system. This system is designed for consistent, repeatable profits, trading for only around 15 minutes or less per week. Once you understand the strategy, it becomes very easy to execute. It's very simple. It's structured. You can do all the math in your head, and you let the process do the work. Trade by trade, week by week, you're going to see consistent results, and it's something that anyone can understand, and you do get better at it over time. As you start to understand the underlyings better, as you start to develop some rules of thumb, then you'll gain some ease of execution. The system's built on discipline, structure, and process. And once you understand that, it becomes very simple to execute. It's important to understand these big picture concepts, risk versus reward. So what we're doing is we have limited risk because we have that put as protection that we bought. So that defines our boundaries. It defines our max loss. And the max profit is defined as the net credit received at the trade entry. So the most money that you're going to make on that trade is what you receive upon opening the trade. Managing that trade at a 2x stop loss or 200% loss is going to help us from the really big losses that blow out our account. And we're going to go through all of the detail of how these put credit spreads set up in future lessons. But for now, here are some key takeaways. You want to use these weekly options for frequent trading opportunities. Get the number of occurrences up, keep your trading size small, and let the law of large numbers work in your favor. Obviously, we're going to be trading liquid underlyings in liquid markets. It's going to help you with your pricing and your execution. Your bid-ask spread should be narrow. And we want to understand probabilities and statistical edge. So our edge is that implied volatility is typically overstated versus historical volatility. So we trade when implied volatility is high, and we take advantage of the fact that the stock is not going to move as much as potentially predicted to the negative side. Let's also look at some key things to avoid. Common mistakes. Common mistakes that we typically see are selling naked puts without protection. We always use the long put as a hedge. A lot of people use cash secured puts. However, you have to have a huge account to make that worthwhile in terms of buying power. Another mistake is ignoring liquidity, selling things that nobody wants to buy. Large bid-ask spreads, which causes poor execution, trading without understanding expiration dates and time decay, also over leveraging. You have positions that are beyond your risk tolerance so that when you do lose on them, you have an outside loss that you cannot stomach. And also not closing out your trades when they hit your stop loss. We use the 200%. Many people use their own number, whatever that might be, and then they don't stick to the discipline in their trade and they go past that stop loss. That's a key psychological barrier that you need to overcome. Here's some key takeaways on terminology and how these set up as a summary. So we've got the short put strike that we're selling. That allows you to collect premium up front. You also have your long put that you're buying as protection, which is going to limit your downside loss. Your max loss is defined. In between is your profit. So that's your net credit. That's the difference that flows into your account between the premium that you collect and the premium you have to pay out for the long put. Max profit is going to be your net credit that received when you open the position. Your max loss is going to be the spread width minus that net credit that you originally collected. We're going to end with a quote here. The key to successful trading is patience and discipline. Over time, the successful trader is the one who sticks to their system, who's disciplined, who closes with discipline, and who trusts the process. Stay calm, stay structured, and let the strategy work for you.